Welcome, everyone. And I want to just say thank you for joining today's presentation. But before we dive in, I want to take a moment to really express my sincere gratitude. And first of all, it's to all our incredible investors who are on this call. Your trust, your vision, your partnership made Grove Parkview possible. And I just want to say thank you. You saw what others couldn't, and your willingness to join us on this journey means everything to me. We would not be here without you. And for our partners who are on this call, your expertise, your commitment, your resilience, your grit, it got us to the finish line and it has been invaluable. And I'm genuinely excited because we have officially closed Grove Parkview. What started off as, an ambitious vision is now a reality, and we're already executing on this amazing business plan that we have, even ahead of our schedule. So today's presentation will take you behind the scenes of this $49.1 million acquisition. We're going to talk about the strategy. We'll talk about the challenges that we overcame and the extraordinary opportunity that this represents, right? And for our existing investors, you gain a deeper insight into how we're creating value with your investment. And then for those who are considering joining us in this or future opportunities, right, you'll see exactly what makes this opportunity so compelling. And I'll break it down. So let's get started. Behind the deal, Grove Parkview, an inside look at this institutional grade asset real estate investing. There we go. It's going to take a little bit of time to switch screens, but we'll make it work. What I'm about to share with you today isn't just another real estate presentation, right? I want to give you an insider's view of wealth creation, the kind that, institutions, they deliberately keep hidden from the public. So I want to pull back the curtain and really show you how this $49.1 million acquisition actually happened. I'll walk you through how we identified the opportunity that maybe some others might have missed. I'll also talk about how we secured financing, as well as really executing on a value strategy that could potentially double investor capital. If you've ever wondered how the truly wealthy build fortunes, you're about to find out. We're going to talk about it all, right? If you have any questions, just put it in the chat, put it in the comments. You can either use the public chat or the questions tab, or if you're on LinkedIn Live, toss your questions in the chat and my team is on standby to help you, and we will make sure that we get all your questions answered. So when I started really exploring entrepreneurship and building Phoenix Capital, and even thinking about pivoting from the ER, right, people thought that I was crazy. But I saw the same patterns in both fields, right? You need to make high-stake decisions with incomplete information. You need to recognize warning signs, even that others miss, and you have to act very decisively when opportunity strikes or when opportunity presents itself. And in the ER, that actually meant saving lives, right? And in real estate, it meant identifying exceptional investments that maybe others might overlook. So think the discipline, the analytical thinking, the risk assessment skills, those things that I developed in medicine, they've actually become a really unfair advantage for me in real estate. And they can be yours too, as I share this opportunity with you, exactly how we acquired it. I want to be honest about, like why you're really here and what you're going to get out of it. You're not just looking for maybe another 8% return or maybe a slightly better investment, right? You're here because deep down, you know that there is a level of wealth creation that happens behind closed doors or behind the scenes, deals that really create generational wealth or is the start to it that maybe never make it to public markets. And you suspected that the truly wealthy, they play by different rules. And I think you're right. And that's why I'm here to talk about this. And I want to invite you into this world, right? It's not just about one property. It's about really accessing this asset class and this investment approach that has created more millionaires than any other vehicle, maybe in history, right? And unlike stocks or bonds or funds, right, that you're at the mercy of market forces. Here, you have direct influence over the outcome. And that's what I want to talk to you about. So in the next hour, maybe hour and a half, just depending on how long we go, I'm going to demystify institutional real estate investing. And you will see exactly how we identified this opportunity that others missed. You understand really why Gwinnett County is poised for extraordinary growth that almost guarantees appreciation. I'm going to walk you through our value add, our value creation blueprint, our plans that really gave us proven successful tips over with like about 100 units already at Grove Parkview. But most importantly, I want to show you how to position yourself, maybe not just for this deal, but for future that you might be thinking about participating. So while others are thinking about maybe investing 50,000 or some 5 million, you will gain the principles and the insights that will fundamentally change how you start thinking about your investment strategy, which I think is the most important thing, because that is the foundation that you need to build. So this is what we're talking about today. We're going to jump in and we're going to talk about Grove Parkview. But first of all, let me just kind of tell you how this all started, right? I remember driving to the property after my partners and I had been awarded the deal. And it's really hard to truly explain that moment. But for me, I was really excited. I was humbled because I felt like it was a chance for my investors to get closer to start really building wealth, or really just start getting passive income, which a lot of them were excited about how to build passive income outside of their 9 to 5. Now, I knew that the work was not going to be easy, but to bring this deal to the finish line, I knew that it really wasn't going to be easy, but I was sure that it was going to be worth it because of the fundamentals. And that's what I want to talk to you today about. So Grove Parkview isn't just a property, right? It is the best way I can describe it is like a perfect storm of opportunity. When you look at the numbers, right, we are acquiring it for $49.1 million. And independent appraiser did appraise the property for $60.7 million. And that was an 11.6 million equity cushion from day one, even before we started adding any single dollar of value. Now, this isn't a coincidence, right? It's the result of our relationship-based acquisition strategy, because it gave us access to opportunities, sometimes even before they hit the open market. So if you think about it, right, we're essentially buying a dollar for about 76 cents. And then we're going to start implementing a value add strategy, which I'll talk to you about. And then we can turn that dollar into about $1.50. This is how institutional wealth is really created. You're no longer chasing yields in efficient markets, right? But you are creating like asymmetric opportunities where risk is less, and then the reward is like tilted to your favor. That's how you have to start thinking about opportunities that you're thinking about getting into. I want to show you kind of another perspective that should make you maybe sit up straight, right? And this, I just want to first of all give you a high level overview, and then we'll go into details. But the replacement cost, right? What it takes to build a property from scratch is approximately around $275,000 per unit, but we are acquiring it at $183,000 per unit. That is about a 33% discount to replacement cost, and that creates an extraordinary barrier to competition, right? Because in today's market, not a ton of developers can feasibly build new product to compete with some of those numbers. So it's not just a good deal. It almost feels like a moat around this investment opportunity. So when you add that into our acquisition, and then kind of what our appraised value is and our below market financing, which I'll talk to you about, this is the reason why sophisticated investors now try to fight to get into opportunities like this. We're playing a different game than your average investor. And that's why it's when you join communities like ours, these opportunities start becoming available to you. Now, this is where I kind of want to start, and then we'll break each of the thesis down. So our investment thesis is built on some powerful drivers that, when individually, they would make a compelling opportunity, but when you combine all of them together, it really truly creates something exceptional. So first, we have a proven value add strategy, right? The sellers who sold the property to us, they had already renovated over 100 units, and those units were getting about $115 to $410 per month. And that's not speculation, right? It's already working. It's what they did on this property. And every renovation that was done, there was always a waiting list of people who wanted that apartment complex. So that's that. The first one was the proven value add strategy. And then secondly, I told you we'll talk about financing. We secured financing at 4.74% in an environment where new loans are generating at around 6% plus or minus, right? So that, when you think about it, that immediately created cash flow with maybe an advantage of around $625,000. So our debt our financing at 4.74% versus new loans at 6% when you compare to kind of market rates, right? So then the third thing that we think about when I talk about those powerful drivers, right? We're in a submarket that's projected about 15% organic rent growth during our hold period, which is 5 years. So that looks like almost a 12-to-1 ratio of growth to supply, just because of how much new supply is coming to the market. So when all these forces converge, right? Think about like operational excellence, all the financing that I just talked to you about, and kind of what the market is doing. It creates this opportunity for really amazing returns. Like I said, this is just an overview, and I want to go into all I just talked about in a little bit more detail. I just wanted to share some photos with you because these photos, they tell an untapped story, an untapped potential, right? So this is what the property looks like. And it's not just all cosmetic, right? It is strategic improvements that the market has already validated. I told you that the prior sellers renovated over 100 units and getting significant rental premiums. The property itself has very strong bones. It's an excellent location, and there are tons of natural features that just can't be replicated. So you're not just looking at buildings, right? You're looking at almost a physical manifestation of a value creation strategy. Every renovated unit just kind of becomes a cash flow engine, because when you renovate every unit, you're increasing your net operating income, and you're also increasing the property value. And that's the beauty with multifamily at scale, right? You think you're doing these incremental improvements, so you're doing small improvements, but then you multiply that over hundreds of units, and it creates really substantial value. And we're enhancing and already performing asset that has significant proven demand. I want to tell you a little bit about kind of the growth engine that is driving the opportunity, and that is Gwinnett County. Gwinnett County is a county in Atlanta, in the Atlanta MSA, and it's not just growing, it is exploding. Last year alone, we had about 13,000 new residents that moved in. But since 2010, population has grown by almost 180,000. But with 180,000 that has moved in, there's been only 12,000 new apartments that have been built. That is a staggering ratio of 12-to-1 ratio of people to new housing. And the Atlanta Regional Commission, they project that Gwinnett County will actually become Georgia's largest county by 2040 with 1.5 million residents. So when I talk about our growth, right, it's not just speculative growth or future potential. It's happening right now. And what you're seeing is a severe housing shortage that will directly benefit existing property owners, just like some of our investors on this call. And here's the kicker, right? There's local opposition to a ton of like new multifamily development, and it virtually guarantees that imbalance will continue. So when demand starts to outpace supply significantly, right? The economic result you see is where rents start rising and the property values are also rising. So we're not just hoping for appreciation, we're investing directly into that path of proving growth. And that's where Gwinnett County comes in. Now, we talked about the county and growing, right? The next thing that we need to think about is jobs. So follow the jobs and you really will find a great investment opportunity. Gwinnett County is experiencing like significant job creation, and it's stemming from a lot of their economic drivers. So for one, Rivian electric vehicle, their plant is bringing in about 7,500 high-paying jobs. And then there's the Rowan Education and the Innovation Campus, and that's about 18,500 jobs that are being created or that will come to life by 2035. And then Amazon Distribution is also adding an additional 1,000 jobs. But then again, that's only thinking about like tech. Hospitals, Northside Hospital has an expansion that's going on that's going to create about 5,000 jobs, right? These are not just minimum wage jobs, they're career positions that and they create the exact tenant profile that we target, right? Educated professionals with rising income who want great property. So you see that companies are investing billions into the corridor, and that's because they see the fundamentals that we do. And so they're voting that their capital is going to work for them. And it's creating this like virtuous economic cycle that will benefit everyone. So when you align yourself with this kind of growth, appreciation isn't unlikely, it's going to happen. Now, I want to talk a little bit about this demand driver that just doesn't go away, right? So regardless of economic cycles, when you think about education, parents desire quality education. And Grove Parkview sits in like the coveted Parkview High School. It's rated 6 out of 10, and it's consistently ranked among Georgia's top schools. The elementary and middle schools are just as great, right? But what this does is it creates a permanent recession resistant demand for families because they're willing to pay rent, premium rents, to access some of these great schools. And I've seen parents who literally break down when they finally secure like housing in top school districts because they know that their kids will be taken care of. And that emotional driver, right, it directly impacts economic value of our property. And so we're really excited that our property is zoned to Grove Parkview High School. But in real estate, right, they say location is everything. Location, location, location. You always hear that. But in multifamily, right, access to really quality schools might actually be one of the most powerful location drivers that really help sustain demand. And that's something that we really thought about. Now, we talked about location, we talked about the school, and we talked about jobs, right? But I also want to touch on the demographic profile that surrounded Grove Parkview, because it's almost like an investor's wish list, because you had an average household income of about 108,000 within almost like a 3-mile radius. And you also had like 73% of the households that earned more than $60,000 annually, as well as the home value appreciation that has happened in the last 5 years of about 70%. All of this, as you start hearing them, they're not just statistics. What they are predictors of rental demand and growth. And that's exactly what the tenants value, right? These are the type of people that we're looking for because they value quality housing, they pay on time, they stay longer, and they can absorb a lot of the rent increases that come as the market improves. So when you combine all these rising incomes with limited housing supply, because I told you the number of people that are moving in versus what's being created, you have this perfect condition for like sustainable rent growth. So we're not just buying a property, right? We're positioning ourselves in the heart of a thriving, upward mobile community that has proven economic momentum. So it's going in the right direction based on kind of what I told you about. And those are the things that we think about when we think about what the market is doing and how we can benefit our investors. So I talked a little bit about supply and demand, and I really want to go into it in a little bit more detail so that you can understand it. And this is another thing that makes the market really exceptional. For every single new apartment that was built since 2010, 12 new residents moved in. That is a 12-to-1 ratio. But that's not enough, right? So that imbalance creates almost like this natural pressure on rents and occupancy. So there's very limited construction in the pipeline, and that is due to rising costs and also a little bit of like community opposition to building new apartments. But what that does is it creates this supply and demand gap and that gap just continues to widen. It doesn't narrow because more people are moving in. I told you it's going to become the largest county by 2040, but there's not enough supply. So not new, no new apartments are getting built. So when you find a market that where the demand is growing exceptionally, but supply remains almost constrained or limited, you almost create this ideal environment for real estate investment opportunities. So it's not just a good market. It is a market that is like really engineered for appreciation, just kind of based on some of the things that I've told you about. So one of the things when we think about like, how did we get this deal right? Winning Grove Parkview, it really just came through relationships. And it's relationships that my partners and I had cultivated over the years with brokers who knew that we could perform without drama, and who knew that we could take the deal to the finish line. When you're thinking about investment opportunities and even in markets, right? When you're trying to buy a property, sellers, they value certainty over marginal, like higher prices. So your bid might be higher, but they really want to know that you will close, that you will get to the finish line and you will end up buying this property. That is more important sometimes than really a higher bid on the property. So that is kind of the thing that you have to think about. And one of the reasons why we won this, right? So our track record of performance, and that combined with, like I just explained to you, the relationship capital, it put us at the front line. And that's the reality with a lot of institutional real estate, right? The best deals are won through relationships. It's not, and it's relationship, but it's also reputation. And that even comes before negotiations start happening. So we secured the opportunity, not necessarily because we offered the highest price, because we didn't, because our underwriting was a bit more conservative, but we presented the highest certainty to close with the least number of complications. And I think that's the most important thing that you have to think about. And so that's something, even as you're thinking about maybe buying, your certainty to close is very important to the broker. It's very important to the seller. And also, I'll tell you a little story, right? We made it to best and final for all of these reasons that I just explained, but we needed to set ourselves apart. And so one of my partners actually drove to Atlanta to meet the brokers, to meet the whole team, and really sold our vision and the reason why we were the right people to take this deal to the finish line. So when you're thinking about one of the reasons why, like, how did we get this deal? It's about relationships. It's about reputation. It's what you're willing to do, and then how you can take it to the finish line. Now, one of the most compelling aspects of this deal is the debt that we assumed. We secured a blended 4.74 fixed rate in a market where, like I told you, new loans are starting at around 6, and some of them are even at about 6.5. But what that did, like I explained to you, is that it just created significant cash flow from day one, because all our money, all our income was not going towards debt, right? So that financing alone, I told you, added about around $625,000 in just annual value. That's compared to like market rates, right? If we had purchased this for 6.5% or even more. So that below market debt, we locked that in till 2029, and that it protects our interest, protects us from any like interest rate volatility. You know what's been happening in the market for the last maybe 3 to 4 years post-COVID, but we are protected, and it really gives us a competitive advantage to maybe new entrants, new people that are coming into the market, because they can't just replicate what we have. And that is one of the biggest ways that we shield ourselves against risk. So if you're a new investor and you're asking, how do you shield yourself against risk, right? This is one of them. We're also not over leveraged, and with 64% LTV, so our loan to value. So we are, we brought significant amount of equity to the deal, and our debt service coverage ratio. So we have about 1.3 times the number, the amount that we need to pay our debt. So these are some of the safety margins that we put in place, that we make sure that we are bringing great returns to our equity partners. Okay, so at about $183,000 per unit, right? Because that's what we're purchasing it for. Like I said before, it's significantly below our replacement cost, and that creates a really extraordinary barrier to entry, because a lot of people can't come in at that cost, and you cannot produce new product, so new apartments at that cost today. And our rents can be competitive because we're buying at such a lower basis. That's what you have to start thinking about. That's what we're thinking about when we decided to purchase this deal. So we built in, like I said, a lot of these safety margins in order to really make sure that our investors are getting the returns that they deserve. Okay, so we talked a little bit about financing. I want to go into our renovation strategy real quickly that we did, right? We went in with a really surgical and proven renovation plan, and we have already started implementing that. And we allocated about $14,000 per unit to our implemented targeted upgrades. And that like I said, right, the market has already demonstrated that it'll pay for it because our prior sellers were doing exactly that. And so the previous owners, they renovated over 100 units, and they were already getting premiums of around $115 to $410. And so our plan, which we've already started, is that we're simply just completing the execution on the remaining 112 units, which is what we plan to do. And so beyond kind of the standard renovations, right, this is something that is really exciting, which is we identified this hidden value opportunity that our previous owner just completely overlooked. So when we went in, we noticed that the studios were really big. So we are going in and we're creating this studio conversion program, right? Because these oversized studios are all going to be converted to about one bedroom units, but there's not a ton of like structural changes that need to happen for us to convert those studios into one bedrooms. But that simple upgrade is going to increase property value. It's going to increase unit costs from like $150 to $200 a month in rent. But it still makes it marketable because people want that one bedroom apartment. That looks like about a 22 to 30% just cash on cash return that's coming in from day one as soon as we start implementing. So when you think about like, how do you make the returns that we're talking, how do you generate those returns? This is exactly the kind of asymmetric returns or asymmetric opportunities that we are looking for, right? So we put in small capital inputs that will create this disproportionate value output. So we are going in and we're converting the studios into one bedroom right away to start getting rent increases of about $150 to $200, which is increasing our cash on cash return from day one by about 30%. These conversions like that, right? They not only enhance cash flow, like I just explained to you, but they also improve like resident profile and just how we can market the property. When you discover these hidden values that others miss, you start thinking about how you can create all these uncorrelated returns that don't depend on market appreciation. So now we talked about interior. I want to talk about exterior renovations that we have already planned to start activating. So we are allocating about $800,000 to strategic exterior renovations, because when you start working on the outside, right, it will directly impact resident retention, but it'll also really impact resident satisfaction. So the first thing we're doing is a pet park. Actually, we're doing 3 projects at first. We're going to do the pet park, we'll do the playground, and then we'll do an outdoor space. When you think about the pet park, right, it seems like just a small addition, but 67% of apartment residents own pets. And then they will stay about 46% longer than non-pet owners, just because they're there, their pets are comfortable, and they just want to stay. And so that is how we pick some of our targeted capital expenditures that we're going in from day one, because those things we know will impact the bottom line. So I also told you that we're going to renovate the playground and the outdoor spaces. And really that's to create community connection, right? Because those are the things that we've seen that will drive retention. So every single amenity enhancement that we're thinking about is really backed by market research. And it's showing that there is truly a direct correlation to resident satisfaction, resident impact, and their willingness to pay premium rents. That's what we think about when we think about the strategy behind how we're going to increase the value of the property. So one of the things is that we're using Asset Living, and they have a large management platform. And so when we start using, when the property management team come on board, which they've already started, they're going to bring significant economies of scale. So they'll think about sophisticated marketing, a lot of operational efficiencies, because one of the things that we want to do is figure out ways to decrease expense, really optimize what we're spending, and also help drive revenue. That's the two ways that we will start really thinking about how we can use our property management team. Okay, so I want to bring it all together, right? And then we will kind of start talking a little bit about what investors are going to make in the deal. So when I think about kind of bringing it all together, right? Think about this value creation roadmap, and this is a comprehensive strategy that we really went in. With how we're going to create value. So based on what I just told you, which is the exterior renovation and the interior renovation, it's going to create about a $19 million additional value over the hold of the deal. So the interior renovations, based on what we're doing, is going to create maybe about $10.8 million in value. And that is just really a result of the premiums, the rent premiums that the prior sellers had gotten, and what we know we can achieve in the remaining 112 units that we're going to be renovating. And then the exterior renovations will add maybe about another 1.8 to 2 million as we enhance the exterior of the property. And then I talked to you about the operational efficiencies that we're going to be targeting, and that's actually going to contribute about $1.2 million, because we're going to focus on expense reduction and revenue generation. So that's how we have to start thinking about like the value that we're creating in this property for our investors. And one of the things that we went in, we were really conservative with kind of our projections. So we projected rent to grow around 3% annually, but the market forecast is looking at anywhere at 4.5% to 5%. So that's another way that we went in to think about how we could add additional value to the property. Okay, so our financial projections, we didn't just build it on best case scenario, right? I talked to you a little bit about our conservative assumptions. And the reason why we did that, because we wanted to get a significant margin for error. Now, when you start buying apartment complexes, or when you start investing, you know that the assumptions you make, they might not always come to pass, right? Things change, but when you add in significant amount of cushion to your assumptions, it really helps decrease your margin of error. That's what we're trying to do with kind of all the assumptions we made. So the property has maintained a 95% occupancy for like over the last 10 years. But we underwrote it for about maybe 6 to 7% vacancy. So that puts us at about 93% occupancy. That's what we are going in thinking that we're going to land. And I told you about our rent growth, right? We projected just above 3%, despite what the market is telling us is around 5%. And our expenses, so based on the age of this property, our expenses should be kind of maybe closer to 45 to 50%, and we landed at around 48.9 to 49% is kind of where we're going to sit. Now, these numbers, they seem small, right? Like it's like a few percentage here or there, but they're not, they really represent millions in potential upside. And that's how you have to start thinking about it. So the 3% here, the 2% here really is significant upside potential. And what we did is like we deliberately built in multiple layers to make the deal more conservative in our underwriting, because we really wanted to ensure that we could achieve these returns that we told our investors that we could. And this is how you think about it. So that approach, right, it just creates a natural upside. So if the market performs as expected, we're good. But if the market also doesn't perform, there's a downside protection because of the margin of error that we put in, the cushion that we put in. So when we started thinking about what do we want to bring to our investors, that's the conservative assumptions that we put into play. This is just a quick breakdown of the investor tier, right? So we did 3 different types of investments for our investors. And as you're sitting here, to everyone who's on the call, who's listening, when you start looking at deals, right, you want to make sure that you want to figure out exactly how each deal aligns with your investment strategy and your plan. So sometimes there's certain investors who just want heavy cash flow. And so we created this opportunity for them where they get 10% preferred return. And that is, you're getting returns even before the operators get any returns at all. So you are really just focused on cash flow from day one, but you're not participating in any of the upside. And so anything beyond your preferred return, you're not participating in it, but you're saying, I really want cash flow from day one, and that's what's important to me. And then you have the Class B and C investors, which they really, they participate in the profit share. So on the back end, they're saying, I'll take the preferred return, which is at around 6 to 7%. And then there's a profit split, right? And that split is 80-20. So these investors, they want cash flow, which they're going to get, but they also want to participate in appreciation on the back end. And that's what that looks like. And that is averaging at around 16.5% average annual return. So that looks at the whole hold of the deal. And like I said, if you have any questions, please toss it in the chat as I'm going. If there's anything that's unclear, I definitely want to make sure that I shed light to it. So beyond kind of the cash returns, right, that you're getting, a lot of our investors really care about the tax benefits. And so this is where depreciation comes in, right? For every $100,000 that is invested, you are generating about $27,000 in depreciation benefits. So you're very able to offset a lot of your passive income. And for many investors who are in high tax brackets, right, this actually can translate to an additional 2 to 3% in tax equivalent yield. And so we, from day one, implemented cost segregation studies so that we can accelerate depreciation, so that you're getting all of those benefits in year one. And then when you combine that with like the strong cash returns that you're getting, and then the tax advantages, all of that is how you start thinking about creating a wealth building engine. And so that's one of the things that we did, right? Another thing is when you think about tax benefits, if you're in a high tax bracket, another thing that you have the opportunity to do is a 1031 exchange. So whenever this property is sold, right, you can roll those proceeds into a like property, and that within 180 days, and you're going to avoid paying capital gains tax. So that's just so different ways you think about when you start thinking about investing and the tax benefits that you're getting. So a lot of our investors ask about risk and how we manage risk. And that's very important because this is your hard-earned money that you're investing in our deals. And so you're asking, well, how do I, to the best of our ability, protect your investment? The first one I want to talk about, which I mentioned before, but I really want to drive it home, is our fixed financing, which we are getting an interest rate of 4.74%. And that actually extends throughout the hold of the deal till 2029. And so it's really protecting us as investors against really any interest rate volatility. And I told you about, we maintain a really substantial debt cushion, so that in case there's anything, we have a DSCR of 1.32. So that means that we are the property is generating 1.3 times the cost of our debt. And so we have enough to cover our debt and to make sure that investors are getting returns. But most importantly is our value add strategy, right? Because that just creates, like, regardless of what the market is doing, you're going to get appreciation based on our value add strategy. And all of these are not just hope-based projections, right? I showed you kind of exactly what we're going to do, what has been done in the past, and what we plan to do, and how we plan to generate those returns. So in worst case scenario, right? Because you have to think about that. And these are questions that I get. When the market flatlines or even declines, these are some of the protected measures or protective elements that are in place that will still help us deliver positive returns. And so as you're thinking about your next investment opportunity, and I wanted to give you a really deep dive into how we were thinking about this, how we went about the whole process, and how we got the deal. This is what you have to start thinking about for even future opportunities, right? This is how you start thinking about asymmetric returns, which is very important. So What I want to also talk to you about is our exit plan. When you start thinking about purchasing a property, you also have to be thinking about, how am I going to exit this? So as you're planning your entry, you are also planning your exit. And we structured this investment with thinking about like multiple different exit pathways so that we can maximize returns. Our primary strategy is that we're going to hold for 5 years, and that's the plan. And then we're going to sell it to an institutional buyer. That is like plan A. And with our value add program, right, that we've completed, and how we've gone in and stabilized the asset, you can definitely see how we would have improved the performance of the property, making it like positioning it as a great institutional quality asset that will come with premium pricing. So our first plan is we're going to hold for 5 years while we complete our value add plan and really stabilize the asset. But we are also open to like full flexibility and the ability to adapt. So if cap rates compress significantly over a hold period, right, we might actually think about accelerating our exit. So think about like exiting earlier than we had planned so that we can capture all of that value. And so if the debt market really offers like exceptional turns, we might also think about, like executing a cash out refinance. And then we've talked to our investors about that. They're aware of all the options that we have as we start thinking about exiting. And so we'll be able to return some of that capital while we'll still maintain ownership of the property. And then also, like, we can also facilitate, like I said, a 1031 exchange into another property, which we talked about. So I wanted to share some of these exit strategies with you that we're thinking about, which means that we are not locked into one single plan. We want to position ourselves for like the optimal exit strategy. And another thing I want to tell you about is you will hear all about this, right? In the monthly updates that we're giving to our investors, you will be informed on the ongoing assessment and like whatever we decide. One of the things that we're big on is transparency. And as we navigate this process, you will know every step of the way as we try to maximize our returns, because that is the most important thing. So that's kind of, I wanted to stop there for a second and really explain that was what we thought about in how we planned to acquire the property. Those are the steps we took. Those are the things that we had in place, how we underwrote it, how we evaluated the market, how important debt and financing was, and that's what got us to the finish line. So when you start thinking about investing, right, you're not just investing in a property. You're partnering with, you have to think about what type of team do I want to partner with? And at Phoenix, right, you are partnering with a team that lives and breathes multifamily value creation. And I will say that what truly sets us apart is not just the experience or the experience of our whole, our team at large. It's our approach. One of the things that we make sure happens is that we invest alongside our partners in every single deal, because I want you to know that there's perfect alignment of interests. So I'm not telling you, and our investors are very aware of that, right? All the investors who came into this deal, they know that we invested alongside with their capital so that we work just as hard for our capital as we work for yours. And also, we don't make money unless you make money. That is also something that's very important. So as you think about future deals, right, make sure that you're asking questions to the operators. What is their investment strategy? What is the business plan? How do I make sure that I, as an investor, I'm protected? At Phoenix, right, our investment philosophy centers around one core principle, and that's really, how do we get asymmetric returns for our investors? A lot of our plan and our focus is to target opportunities where the downside is limited, just like I went through with Grove Parkview, and that we look at opportunities that really downside is limited and it's very protected, and then the upside is substantial and it's achievable. So everything that I've gone through today and that I've explained to you, kind of the thought process behind what we did and what we're planning on doing, is very achievable. Also because we know that the prior sellers have done just that. And so a lot of it is just continuing from the momentum that they, where they left off, and just taking it from there. But that has helped us build a track record. And it's really helped us create a community of really loyal and repeat investors. You have to be thinking about that as you think about investing. So I wanted to share with you where we are today and our plans for future growth. And what you're seeing here isn't just a portfolio, right? It is proof of what's possible when vision meets collective action. So it's knowing the vision, knowing the mission, and then taking action to achieve that every single day. And every property that you see here, it represents a community of investors who decided to break free from traditional investment and to think about alternative investments and how to grow wealth, how to get passive income aside from their 9 to 5. 3 years ago, we just started with one property. But today, with the inclusion of Grove Parkview, we control over $95 million in assets that are performing or outperforming market averages. And while maybe I'd love to take credit, it's not just me. The truth is that this growth really happened because individuals like you saw the opportunity that I did and decided to act on it. And so we're doing this together. We're doing it as a community. We're collectively growing wealth together. Some people started at 50,000, some started at 150,000, but they all share one thing, right? They understand the value of legacy and wealth creation through assets like this that a lot of large institutions typically keep for themselves. So the question is not whether these work, right? The question right now is, do I want to be part of the next one? How do I position myself? How am I learning? How am I growing? How am I linking arms with the right people who will, one, open the doors for these opportunities, but also two, will educate me and make sure that I have a seat at the table to make sure that opportunities like this are available for me as well. That is how you need to be thinking. Did it move? There we go. So excellence does not happen in isolation. And I want to say that I'm standing here today, not because of everything that I've done on my own, but it is truly the amazing partners that I've had. And these are truly strategic partnerships that have been built over time, and they are able to shine in every class across every discipline. And our team of partners, they share in our commitment to excellence, exceptional execution, and I can't say enough about them. We have Excite Capital that's made up of Dr. Julius Oni, Leslie Awasam, and Tenny Tolafari. And they're a group of guys who are really determined to bring the asset multifamily investing to our community at large, and to let you know that wealth truly can be achieved when we link arms together and when we grow. And they have acquired $217 million in assets under management and continue to grow. And it's that vision, that relentless drive that you see. Chris Lento with EM Capital. Chris is the master asset manager, and he brings 21 years of experience to our team. And that's the team that you're getting at Grove Parkview, right? And you should hear him talk. It's a sight to see, because he understands truly how to manage an asset and how to help, that asset grow and create the value that we put on paper and to bring that to life. And then we have Brad with Crest City Capital. And Brad is a hands-on, amazing developer in the Boston area, and he's just significantly growing, and he's brought a wealth of knowledge to what we're doing at Grove Parkview. So when I tell you that, I started with saying how honored I was with the investors that we brought into this deal, but our partners are truly 10 out of 10. Think about the people that you want to walk. Grove Parkview wasn't easy, but we linked arms together and we saw the finish line, and we worked hard to make sure that we brought this deal to our investors and that we followed through and we closed. And it's truly because of the team that you see on screen. And then I want to talk a little bit about our property management team, because you need to understand that this is a large partner team that we're working with, but with it comes significant technology stack, a ton of operational efficiencies, and really market knowledge. They know what's going on in the market because they're in a large array of markets, and they bring that expertise to Grove Parkview. But that is our property management team at large. Our on-site team, when I tell you these people are family, I mean they are rock solid. Together, there's 7 of them, and they have about 75 years of experience on that property. They know the property inside out. They are loved by the tenants. So the day we sent an email out to the tenants telling them that we had acquired the property, a lot of them, I heard that a lot of them showed up to the clubhouse and made sure and was inquiring and making sure that the team on site was staying, because they were like, if you're leaving, we're leaving with you. When that's the type of people that we have on site, and that's what makes this property so unique and so amazing. So, and all the things that I'm telling you how excited I am, the on-site team just really tickles me. And every time we talk to them, you can tell that they're devoted to making sure that tenants are happy. And, happy tenants means that they stay with us longer and investors are really happy. But that's kind of at the core of what we do. That is what's important. We make sure that they're taken care of and so that they can take care of our residents. So thinking about our 2025 plan, right? Where are we? What are we doing as a company? Grove Parkview just represents the first step in our ambitious 2025 acquisition plan. We have set a disciplined target to acquire 3 acquisitions this year. And we're really focusing on exclusive opportunities, just like Grove Parkview, that meets our criteria. And so far, we have reviewed and underwritten about 300, a little over 300 that's reviewed and underwritten together. And we have submitted 3 with a plan to submit another one next week. And so as we are continually looking for our next opportunity, right, we're very selective about how we show up. We're selective about the deals that we look, because we want to make sure that we bring the right deal to our investors. So we are only pursuing opportunities with really exceptional fundamentals, just like Grove Parkview. The same scrutiny that we use in Grove Parkview is exactly how we use in every single deal that we look at, that we think is a right fit for our investors. So as we execute our 2025 strategy, right, our investors are gaining access to not just kind of what we're doing, but they see behind the scenes on really how we think, how we select the assets. And then also they understand how we want to identify, that needle in the haystack opportunity, because when you find that, that is really how you're going to drive and get significant returns. So we are very strategic and we are very methodical about really how we look for our assets, how we underwrite, making sure that we bring the right deal to our investors, just like Grove Parkview. So a lot of people kind of ask some of the lessons that we learned, and I really want to share that with you. I will say this: success leaves clues, but so do challenges, right? And some of the most valuable insights that I have had in our business, it didn't come from like all these theoretical models, because they're there, but it really came from real life experience and execution, just like as we started to implement some of our business plan in different market cycles, right? And one of the lessons that I would say that I learned is that it is very important to underwrite conservatively. And it's like you have to do that so well, because actually conservative underwriting is very profitable, because it gives you a cushion and really significant margin for error if something were to happen. And so when you build multiple layers of conservative approaches into your underwriting, you just create natural upside potential. And while decreasing a ton of the downside scenarios that could happen, you're protecting against that. They will happen, right? The deal that we underwrote, or all the assumptions we make, as we start really bringing the deal to life and stabilizing it, some of those are not going to be true, but we're protected against the downside. That's how you have to think about it. Now, I will say this, and I've learned this, and if you hear one thing, I want you to hear me say this, right? I have learned that the true alpha in real estate is through relationships. It's creating relationships. And I saw this over and over. We got selected based on our relationships. The lending process was easier because of the relationships that we formed. It took one phone call or one text message or one email, and the answer was yes. And so we got partners that we needed because of the relationships that we formed. And you'll see that our investors really trust that. So one of the things, that lesson learned, right? we struggled with raising capital. And when we were at about 70% of our capital raise, right? We couldn't see the path to the finish line because like just based on where the economy was, capital wasn't flowing as much. And so at that point, doubt started to creep in because we said, where are we going to get the remaining 30%? But instead of letting that get the best of us, right, we doubled down in our core strategy and we focused on, really getting sophisticated investors who truly understood the opportunity. And I will say this, right? Every step of the way, we communicated with our current investors that we were at 70%. We communicated with them when we got to 80%, but we were very transparent about some of our struggles. But it didn't deter our investors because they trusted us and they saw the transparency. And even some of them increased their investments after they figured out that, okay, we were having a little bit of a hard time getting to the finish line. But we kept them in the loop every step of the way. But we didn't stop, right? We were focused, we were resilient. We like defined what grit meant, which meant that we were just in the face of adversity, we said we were not going to stop. And truly, it was that mindset and that attitude that got us the remainder of the equity that was needed to close the deal. So that lesson was very profound, in real estate, but also in life, right? Breakthroughs will come at the moment that you feel like giving up. And there were a lot of those times. But the difference between success and failure, it's not about avoiding those obstacles, right? It's about having the mental fortitude to keep trying to solve those problems when others think about quitting. And so every impossible situation is just it's just a problem that's waiting for a creative solution. That's how you have to start thinking about it. And this deal made us think and come up with really creative ways to solve problems. So I'll talk about one more lesson that we learned, and then I'm going to wrap up. So I think probably the most powerful lesson that I learned is what Grove Parkview really represents, right? It is proof that institutional quality assets, they're no longer reserved for the BlackRocks and the Blackstones or this billion-dollar private equity firms, right? We together, we shattered the myth that only Wall Street titans can get access to these opportunities. We learned firsthand that a community of investors, doctors, business owners, busy professionals actually came together to acquire $49.1 million. And that most people would assume is like beyond our reach. We came together and we did it. We were not just passive participants anymore. We were actually active players, which are shaping the outcome through strategic execution. And that is the power that our investors saw in us and that they wanted to link arms with us. And so Grove Parkview no longer isn't just an investment, right? It is a statement what's possible when vision meets collective action, which I told you in the beginning. But this deal really fundamentally changed how investors view their wealth building potential. They now understand that those barriers to institutional real estate investing, they aren't as impenetrable as they thought, right? They once believed that it was only for a certain collective group of people, but it's not anymore, right? Like I said, it's for doctors, it's for healthcare professionals, it's for business owners, it's for busy professionals. That's the community that we're building. And the real game changer isn't just that. It's not just the property, right? It's that realization that like this level of investing is now accessible to all of us, and that we can now step outside of these conventional limitations and think bigger. But I will tell you that this is just the beginning to what we're going to accomplish together. And as I sit here kind of sharing with you the blueprint of our thought process, how we underwrote, how we thought through the market, how we thought about financing, how we thought about our value add strategy. I also want you to think that this is the beginning of all that we can accomplish together. And it started with this institutional grade quality asset that is Grove Parkview. So as we come to a close with our time together, right, I want to be direct and I want you to hear me, because Grove Parkview really represents this rare alignment of opportunity that is available to sophisticated investors, immediately they recognize that it is available. So it's not just another apartment complex, right? It is a wealth creation vehicle with all these extraordinary characteristics that I talked to you about, that we had built-in equity from day one. We have a proven value add potential with over 100 units that already happened, that was demonstrating significant rent premiums. And then we had below market financing, and that is locked in till 2029, right? With that fixed interest rate that I talked to you about. And then we picked a location that is like one of the nation's growth corridors, because as I told you, it's going to become the largest county in Georgia in 2040, 2045. But I want you to know that whether this is your first real estate investment or your 50th, right? Understand that these fundamentals speak for themselves. And as you start looking for deals, or as you start thinking about who you're going to invest with, I want you to think about these fundamentals that we talked about today. You know, when we first undertook this acquisition, like, we all had doubts, right? And we also had it, but we heard the doubts. We heard it from a lot of people who said, this deal is too big. You won't raise the capital. You can't compete with institutional buyers. But we refused to accept those limitations. We refused to say that we were only going to be limited to this asset class or this amount of money, right? But I'm sitting here today and telling you that we not only closed the deal, but we are now executing on our business plan, and even ahead of schedule. And it's really because we believed that we could, and we did the work. And so it's that combination of faith and massive action that got us to the finish line. But I want to talk to you today because if you are thinking about, hey, is this something that maybe I want to do? If you're thinking about, is this something that maybe I want to jump into, right? Because a lot of people doubted that we were not going to do it. Even after we closed the deal, we had a lot of people who started asking, can I get into this deal? When is the next one? Because they saw what is possible when we come together, right? So we set aside a very small allocation, specifically for those people who are like, maybe now that we closed and they saw this opportunity, they're sitting on the sidelines and they're now like, I really want to jump in. And it really truly was just a very small allotment. And it's only for kind of available for a very short period of time. So if you're thinking about, man, I don't want to sit on the sidelines anymore, I want to jump in, this is your opportunity. But the reality is that opportunities like this, right? Built-in equity, proven upside, favorable financing, they just don't come around that often. And especially not in today's market with what we're seeing. So if you are thinking about it, if you're thinking maybe this is something that I still want to jump into, I really want to fully understand what is going on with multifamily real estate, there should be a link that has gone up, or the QR code. And if you're on LinkedIn, I'm pretty sure that we put the link on, but just answer a very quick, brief questionnaire, and one of our team members will reach out to you. And really, the purpose of it is to understand your investment goal and understand what you want to do with your wealth creation plan. That is what that conversation will be about, and we'll figure out really how we can align together. Also, if you're just new here, which I see a bunch of new people, and you just want to learn about what we do at Phoenix, or how we can help you build legacy wealth with investing in asset classes like multifamily real estate, then just scan the QR code again and fill out that quick questionnaire, and we'll definitely, either me or someone else on our team will give you a call, and we'll just have a conversation with you to fully understand what your goals are. And so that's that. Now, the question that I want to leave you with as we wrap up, the question isn't whether this is a great opportunity or whether this is an opportunity for you, right? The fundamentals speak for themselves. And that's what I wanted to walk you through today. That's not the question. The question is, will you take action? Do you want to be a part of this? So think about that as you sit and as you learn, as you take in all this information, right? You have to start asking yourself, is today the day that I'm going to take action? Do I want to be a part of this? And if the answer is yes, again, scan the QR code or just click on the link, and it'll take you to somewhere where if you just fill out some quick questions, we'll get a hold of you. But I just want to say thank you for your time and your attention today. I see some questions in the chat. So as soon as I will run through those questions right now. But if you have any questions, dump them in the chat. I'd love to answer them. I look forward to partnering with you in the future. So thank you for your time, and thank you for spending this hour with me. So I will jump to questions. And okay. So I have a question in the chat. Is there a reason that some deals are exclusive to accredited investors? Would allowing to non-accredited investors in on the deal alleviate the finance hurdle? This is a great question. So the Securities and Exchange Commission has rules, right? And one of the rules is that these investment opportunities are only allowed to accredited investors. And for you to be an accredited investor, you have to make $200,000 in income this year, and you have the potential to do that as well next year. And then you had to have made that the prior 2 years. Or you and a spouse come together and you have $3,000 in income, and that's like your job. Then another requirement is that you need to have a net worth of $1 million that is outside of your primary residence. And a lot of that is to protect you as the investor. Now, the second part to your question is, would you allow unaccredited investors to come into deals like this? And the answer is yes, right? So there are deals that are structured as in different types of deals. Different type of deal structures are done that will allow unaccredited investors, right? So you have a deal, a type of deal that is a 506B deal. And so that deal, unaccredited investors can come into it. But this is a 506C deal, so it's only for accredited investors. Now, also, towards the beginning of this deal, right, because we knew that a lot of our investors were non-accredited investors, we created that opportunity for them to be able to come into this deal. But that was for a very short period of time. And now the deal is only for accredited investors. But to answer your question, there are opportunities where you can come in as an unaccredited investor and to be able to invest in deals like this. And that what you'll do is, like I said, if you click on that link that I just told you about, you'll be able to put in your information, and I'll definitely be able to get a hold of you or one of our team members. But you also have access, so you will know every deal that we're looking into, every deal that we are every deal that we put an offer into. You will get first access to it. So when we have deals that are available to non-accredited investors, you will have access to that. So that's something to think about. But I would definitely keep you in the loop so you know what we're doing. Great. Okay, I saw that question. You're very welcome. I'll stick around a little bit because I know that some questions might be coming in. There is another question that is coming in, and someone is asking, how often do these deals come around? So I talked about that a little bit earlier, and we are constantly underwriting and we're constantly reviewing deals. And we're constantly putting in offers, right? So it just depends on, based on our criteria and based on our investment strategy. If there's a deal that we have underwritten that meets our investment criteria, we will put in an offer. And if we win the deal, we will definitely bring it out to our investors. So in as much as we are underwriting a lot, some of the deals that we're looking at are just not penciling, which means that the asking price is just too high based on some of our conservative underwriting. So we're not very quick to put in offers if the numbers just don't make sense. So as soon as we get the deals, as soon as we find the next right opportunity, we will definitely make you aware. Okay. And I think that if there are no more questions coming in, we will wrap up. So I just want to say thank you, everyone, for your time. Thank you for this Thank you for hanging out with me this hour and 15 minutes. I look forward to connecting with all the people who have already filled out the questionnaire, but have a wonderful evening.